Today is February 20th, 2026, and the silver market continues to be one of the most talked about, most dramatic, and frankly most fascinating stories in the financial world right now. So, let's get right into it because there is a lot to unpack. Silver prices have risen by roughly 11% in 2026, as of early February. The Silver Institute, and the story behind that number is far more complex than a simple percentage can tell. To understand where silver is right now, you have to understand where it's been over the last few weeks, because what happened in late January was nothing short of historic. Silver prices surged to over $120 per ounce, driven by physical supply constraints, Chinese demand, and strong speculative flows. CME Group. Think about that for a second. $120 per ounce. Silver had broken through the psychologically critical $100 barrier for the very first time in history. The internet was buzzing, retail investors were flooding in, and mainstream financial media couldn't stop talking about it. Then came the crash, and it was brutal. Silver lost almost 30% in the biggest one-day blow since 1980 for silver futures. CNBC. The sell-off shocked even seasoned precious metals traders. What triggered it? President Trump's nomination of the hawkish Kevin Warsh as the next Federal Reserve Chair strengthened the U.S. dollar and caused Comex active silver prices to plummet over 31% intraday. CME Group. When markets heard that name, Warsh, known for his preference for tighter monetary policy, the dollar surged and non-yielding assets like silver got hammered almost instantly. The Chicago Mercantile Exchange also increased the margin requirement on silver from 11% to 15% as prices hit record highs. This forced highly leveraged speculators to either pour massive amounts of capital into the system or close out their positions instantly, turning a market correction into a crash. CFI, that's a critical detail a lot of casual observers missed. The CME's margin hike was essentially the match that lit the powder keg, forced liquidations cascaded through the market, and silver went from all-time highs to a freefall in a matter of days. Now, as we sit here on February 20th, silver has been in recovery mode, but the ride has been anything but smooth. Silver rose to $84.72 per ounce on February 11th, up nearly 5% from the previous day, as safe haven demand was fueled by a rotation away from dollar-denominated assets amid growing concerns over policy uncertainties in Washington. Trading economics. But even with that bounce, the metal remains well below those January record levels. Silver paired earlier losses and traded near $82.50 per ounce in mid-February, snapping a two-day advance as profit-taking resurfaced and volatility lingered after the historic late January liquidation. Trading economics. So what's keeping silver afloat even after such a devastating sell-off? The answer lies in the fundamentals, and they are deeply supportive. The silver market is expected to remain in deficit for a sixth consecutive year in 2026 at a noteworthy 67 million ounces. The global silver market will continue to rely on the release of bullion from above-ground inventories, adding pressure to an already tight physical market. The Silver Institute's 6 consecutive years of deficit. That is not a minor supply imbalance. That is a structural story that doesn't go away just because speculators get squeezed out of their positions. Despite the paper market collapse, silver is structurally in a deficit because of AI and solar demand. CFI. This is the part of the silver story that long-term investors need to keep front and center. Every solar panel produced requires silver. Every electric vehicle, every AI-powered data center, every semiconductor chip, silver is embedded in the backbone of the modern technological economy in a way that makes demand almost inelastic over the long run. Even if prices stay elevated and industrial users try to reduce their silver inputs, the sheer scale of the green energy transition and the AI infrastructure build-out means demand is not going anywhere. Silver had a stellar 2025, outperforming gold with an annual gain of 150%. CNBC, let that sink in, 150% in a single year. Even after the brutal sell-off, anyone who was holding silver from the start of last year is still sitting on enormous gains, and that performance has reignited interest from institutional and retail investors alike. Physical investment is forecast to rise by 20% in 2026 to a three-year high of 227 million ounces. After 3 consecutive years of decline, Western physical investment is expected to recover in 2026 as silver's exceptional price performance and ongoing macroeconomic uncertainty rekindle investor interest. The Silver Institute. Now let's talk about what the big banks are saying, because their outlooks are worth paying attention to. UBS forecasts that spot silver will return to the $100 threshold in the near term, before falling back to around the $85 level by the end of the year, CNBC. That's an interesting projection, bullish in the short term, but tempering expectations for year-end. UBS also flagged an important structural concern. With more than half of silver demand tied to industrial applications, elevated prices could gradually reduce how much silver industrial users consume as manufacturers seek alternatives or find ways to use less of it per unit of production. Goldman Sachs analysts were similarly cautious on silver compared to gold, citing supply constraints in the London market as a near-term risk factor. The London physical market has been under significant stress, and that tension is something traders will be watching closely in the weeks ahead. On the macro side, markets currently price in roughly 60 basis points of Federal Reserve easing by year-end. Trading economics that's meaningful for silver. When the Fed cuts rates, the opportunity cost of holding non-yielding assets like silver decreases, which historically provides a tailwind for the metal. Weaker U.S. data shifted expectations toward easier monetary policy, with retail sales unexpectedly stalling and the GDP control group falling, reinforcing signs of slowing demand and easing inflation pressure. Trading economics. If the economic data continues to disappoint, the Fed will almost certainly be forced into a more accommodative posture, and that should provide silver with a supportive floor. One more thing worth watching right now: the Chinese Lunar New Year break runs through February 23, 2026, and a further reduction in Chinese speculative money during this period could result in thin markets with extreme and unpredictable volatility. CFI. So if you're trading silver actively this week, be aware that liquidity may be lighter than usual, which means moves in either direction can be exaggerated. Once Chinese markets fully reopen, we'll get a much clearer picture of whether domestic demand, both industrial and speculative, is coming back strong. The bottom line on silver today is this: the metal has been through one of the most dramatic episodes in its history over the past month. It hit all-time highs, got absolutely crushed, and has been clawing its way back ever since. The fundamentals, persistent supply deficits, industrial demand from solar and technology, rising physical investment, and a macro environment that still leans toward rate cuts, remain solidly bullish for the long term. The near-term picture is volatile and uncertain, especially with thin holiday season liquidity and ongoing macro noise from Washington. If you're a long-term holder of silver, the structural case has not changed. If you're a short-term trader, this market demands respect and discipline right now. As always, do your own research, manage your risk, and don't let the noise drown out the signal. That's your silver market update for February 20th, 2026. Drop your thoughts in the comments below, and we'll see you in the next one.